Hello, everybody. This is Jake Senzano, host of Jake and Gino Podcast here with my co-host, the multifamily mentor, the coach of chef, the father of six, the best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Jake, I'm doing good, brother. How you doing?
Always making it happen, big man. Today's guest is a best-selling author, CEO of Short Term Shop, and one of the nation's top experts in short-term rental investing. She went from making $37,000 a year to building a portfolio of over 250 doors in just 5 years. And now she's on a mission to help others achieve financial freedom through vacation rentals. So without further ado, Avery Carl, welcome to the show.
Thank you so much for having me. And I appreciate you saying vacation rentals and not Airbnbs because there is a difference. So appreciate you.
Well, I didn't know that. Well, I guess we're about to find out. I was actually watching Landman the other day, and they were talking about like the biggest industries in the world, and I noticed that tourism was on there. It was number 5 largest industry in the world by revenue. So was this like a master plan that you're like looking at these economic factors and said, I'm going to get into this industry, or is this something that you stumbled into? Just love to kind of hear how you got into the space here.
I would love to say that it was a master plan. I'd love to say that, but no, it was all a complete accident, and really stemmed from hating corporate life. And we kind of got into it when we had just gotten married. And I was already like, I'd go for walks with my friends on my lunch break and be thinking about having kids sooner or later, or we didn't know, and like, I can't have this job that I have now. My boss, this work from home was a thing, but it wasn't COVID yet. This was back in like 2014. And I was like, my boss there's no working from home. Even though our company allowed working from home a couple days a week, she was like, not. And you could not leave at 5. You had to stay until she was done, which is fine. I'm not trying to be a millennial. Maybe I am, but I was just trying to think like, man, this is not something that my boss is not going to understand. Oh, my daughter has strep throat. I have to stay home with her today. And so I had a lot of anxiety around that. And like, well, what can I do business wise to be able to work from home so that we can't just kind of like floundering, trying to figure out planning for a family and our future. And we had about $10,000 saved up. We just got married. I was 26. He's a little older than me. So anyway, I was going to make a joke about that. What are you working
for? If he's older, he should just let you stay at home then.
Well, yeah.
Come on, bro.
I like to work. I start climbing the walls. I got to have something to do. So anyway, we had a little bit of money saved up, like, I don't know, like $10,000. I was super into like Dave Ramsey and personal finance, things like that back then. And we went to an Edward Jones office that was in the same building as my corporate job to see what we could do with this. Like, sure, maybe it's not that much money, but surely there's something we can do to grow this and be smart with it. And she pretty much told us, you don't have enough money for me to bother with. And we're like, oh, great. So
that wasn't very nice.
Yeah, she did it in a very nice way. And thank God she did, because that money would be sitting in the stock market and we would not have 250 doors. So we left, and the wind totally let out of our sails, and we're like, well, now what do we do? And we had just moved from New York City to Nashville, probably like 2 years prior. And our
What year was this?
This was 2013.
You moved to Nashville in 13.
Yeah, moved to Nashville in 13. This was 2014 that we're kind of like, okay, what do we do with this money? And our real estate agent, when we moved, was really trying to get us to buy in East Nashville, which was like the super hip area. And she was like, man, these $120,000 houses are appreciating $50,000 to $100,000 a year.
Why'd you move to Nashville from New York City?
Oh, yeah. So I met my husband in New York City. We were both in the music industry. So he was a classic rock DJ on Sirius XM. I had been in a touring guitar and bass player in a bunch of punk rock bands that nobody's ever heard of. And we wanted
the Flying Pixie Sticks?
No. So it was a band called The Applicators. It was all girls. I don't know if you guys are going to get that reference, but the girls listening will.
Don't need to. Just pass on.
And I had,
I honestly have no idea, but I don't want to know either. So
I had a bunch of other gigs. So I went to started out in Austin, went to UT Austin on a soccer scholarship, then was in LA, then in New York, graduated in 2009, worst possible time to get a job as a new graduate. So just went on with the music thing, bartended, ended up in New York doing that. Met my husband there. He worked again for SiriusXM, and then he also owned a bar on the Lower East Side. And we just got to the point of like, okay, you know what? We're together. We're probably going to get married. We live in this tiny apartment in Brooklyn. One of us would have to double our income in order to just upgrade. So Nashville had a Sirius studio, and Nashville also had no state income tax. So we said, oh, wow, we can move to Nashville, get a raise just by not having state income tax.
You guys were smart and cool before it was cool and smart.
Yeah. It was a little bit before everybody moved to Nashville and ruined it. But so we moved there, and we had enough money to buy a house. So we did. And we didn't want to buy in East Nashville because we're like, we're coming from Brooklyn. We don't want neighbors. We want to go out in the country in Tennessee. So that's what we did. But we started thinking after this financial planner told us we didn't have enough money. Well, that appreciation thing sounds kind of interesting. If we saved a little bit more money and put that down on a house in East Nashville, put some renters in it, let them pay the mortgage and the bills. And in 20 years, when our future kids need to go to college, then maybe we can just sell that house and pay for it out of the appreciation. We'll be these great finance geniuses. Like, we didn't even know it was called real estate investing. Just did it.
Appreciation.
So dumb. Guys, don't take that. I've learned a lot.
Listen, everything that you said sounds genius. You moved to Nashville before it was a thing. You probably made some money there, and you decided to invest into real assets. I think you sound extremely smart and intelligent.
Well, make sure
you were punk rocking.
Yeah, it was. When we moved to Nashville, I went back and got my master's degree because the job market swung back around. Yeah. So anyway, so we bought a house, and that long-term rental, the mortgage on it was $647 a month. We were able to rent it for $1,550 a month, almost $1,000 on a long-term rental, which coincidentally was about my salary at what I thought was my dream job in the music industry. I was making $37,000 a year. And after all the deductions and everything, I was making about $1,000 a month because the music business is sexy and there's always somebody who will do your same job for less. So we're like, oh, wait a minute. This house is making as much money while we sleep as I make driving in Nashville traffic from White House, Tennessee to Nashville every day, dealing with all this crap. We're not going to be able to have kids or build a family while I'm in this job, but I still want to work. So we're like,
let's do it again. Let's do it again.
Yeah. So we had a little bit of money left, and we said, well, what can we buy that's going to make us the most amount of money the fastest? And we landed on short-term rentals, but we didn't want to do it.
What year was this?
It was the beginning of 2015. We bought our first short-term rental in 2015. So 10 years ago.
Why didn't you want to do it in Nashville? That was like a perfect time to be doing that in Nashville.
Because Nashville was already very anti-short-term rental. And like, we were scraping pennies out of the bottom of my purse to make this down payment. So we could not afford to buy a house. And then a few years down the road, Nashville say, oh, never mind, can't do it. Yeah. So we wanted to find somewhere a little more stable for that. And we'd just been to the Smoky Mountains on vacation. It was about 4 hours away from Nashville. We'd stayed in a rental cabin there. All the people who were there with us had stayed in rental cabins. We figured somebody owns these rental cabins, and it's like the normal thing here for people to go and stay in these rental cabins. Whereas in Nashville, it's kind of like a new thing.
Smokies is huge, like number 2 behind Vegas in terms of like tourism, right?
Yeah, it's up there. I hadn't heard that statistic. I know it's the number 1 market on Airbnb's list of booked nights in the world. But this was, well before that. Airbnb was kind of new.
Again, you're getting in early. You're getting in good.
We did get in early. We did. And there were no like people on the internet telling you how to do that back then. So we just kind of figured out how to manage it ourselves from Nashville, because when we talked to property managers, their average split was 40% of your gross. And we were like, no, we need that 40% so we can buy more. So we just figured out how to do it with a cleaner, a handyman, and our phones.
What was the handyman? What was his name? Chuck?
No. What was his name? He's Shane.
Shane's no longer with the group.
So 40%. Let me understand that they want to take almost half of. I could see. I'm sure it's down to 20, but I don't even understand how you could actually ask for 40% of somebody's revenue.
What are you, the government?
They're worse than the government. Oh gosh. Let me understand the difference between the vacation rental and an Airbnb. You said there was a difference. What's the difference between the two of those?
Okay, so vacation rental is a property like a beach house, cabin, lake house, mountain house in an area that it's the normal thing, like the Smokies,
Tourism.
for people to go on vacation and rent these things. Yeah, an Airbnb would be like, I'm going to go in this primary home neighborhood in Indianapolis and turn this house into a short-term rental where a bunch of people live. So I invest only.
How long do they
in
live there
vacation.
in the short-term rental?
How long do they live there?
Like in the Indianapolis thing, because now I'm like confused on the whole thing. So you're in Indianapolis. How long are you there for?
Oh, I don't know. I wouldn't invest in Indianapolis for short term. So
like if you're doing the Airbnb thing, like what would be a typical stay of somebody in like Indianapolis for Airbnb? You said.
I don't know. That's not the type of market that I invest in. So I'm
just trying to understand the differences. Like, is they stay for a month? They stay for 2 weeks?
Oh no, the difference is just the type of market and what you're doing to the market by investing and having.
Not the time to stay. It's more of like this is somewhere in a vacation spot versus just downtown Indy, right?
Yeah. So buying in a vacation spot that. Most of the real estate that's traded in these types of markets has always been second homes and vacation rentals, as opposed to going in a market that short-term rentals are kind of a new thing and turning a bunch of things that would have been long-term rentals or starter homes into Airbnbs.
Avery, what markets work really well for your strategy for the vacation rentals?
So I personally invest in the Smokies in Tennessee and the Emerald Coast of Florida and the Forgotten Coast of Florida. So in the Emerald Coast, I've got Destin 30A. And then the Forgotten Coast, which is just a little bit east of the Emerald Coast, Cape San Blas. So these are areas where people go.
What's that, like the other side of Panama City or something?
Yeah. Mm-hmm.
But right Avery, if I'm listening to this, what are your metrics or what are you looking for in a market to be able to invest in and to think that it's a really good, stable, growing market for your niche?
So for me, I like regional, drivable, very mature vacation rental markets. And what I mean by mature is, short-term rentals have been around for decades and decades. So, and vacation rentals, that's why those property managers 10 years ago could take 40% because Airbnb didn't exist then. There was no way for us as owners to make money. The only way to make money on owning a second home or a vacation home would be to put it on one of these local property managers. So the onset of Airbnb just kind of democratized that and made it an asset class where you actually could make money. It's not a new asset class, but it just kind of changed it to where you can actually cash flow on it. But anyway, regional drivable, I don't want to see a lot of hotel presence. I want it to be dependent on tourism because even if
that's why the Smokies is great then.
Yeah, Smokies, Destin, Florida, places like Myrtle Beach, Branson, Missouri, areas like that. Think of places maybe that you went growing up with your parents where you stayed in a single family home or a condo rather than a hotel. Those are typically the types of places you want to look.
And what are the risks inherent in that model? Because I live in St. Augustine, Florida, and I would assume that I know it's a great area for vacation rentals. The problem is that the locals are starting to like it less and less. They are building more and more hotels, although the demand for vacation rentals is still astronomical because of the night of lights, because of the beach, because of the city and all. What are some of the pitfalls or some of the negative things that you're seeing going on in this space right now?
Yeah. So before you do any research, don't even get on Zillow in a market before you call yourself. Don't have your agent do it. Don't take the internet's word for it. Call the city or the county, depending on where the properties you're looking at are, and see what the rules are for short-term rentals. So areas like over here in 30A, we have 10,000 of us who live here full time. We have 10 million people who come here every year, and they only want to stay in vacation rentals. They don't want to stay in hotels. It's groups of people where hotels would not work. Whereas St. Augustine, I've never been to St. Augustine, but that's more of like an actual city where people are coming there. Yeah, it does have the vacation element, but there are other industries outside of tourism that allow it to exist without that.
Yeah, so 30A would be in trouble without the vacation rental space.
Oh, it'd fall apart.
They don't want it going anywhere, right?
No.
They get it.
Yeah, and they make so much money on the taxes from us owners that
because your taxes are probably higher, yeah.
It's not too terrible. I can't remember. It's like 7 or 8% on occupancy tax. It's not too bad, but without that, there's again not very many.
Let me say it like this: the value of the real estate has gone up due to the vacation rental. Therefore, they can get more in taxes. Is that a better way to put it?
No. So the value on 30A is kind of different. It's more of a luxury market. Like there are $25 million beach houses across the street from me that would be the worst short-term rentals imaginable because they're so expensive that the numbers don't work. So
yeah, but the infill stuff that you're renting, though, I have to imagine is worth more because there's an income approach that can be derived from it. No,
But they're also generating revenue from the short-term rentals also, Jake. That's where she's talking about revenue, not just property taxes.
Yeah, not property taxes.
No, I get it. But what I'm saying is I may be completely off on this, but I feel like the values are higher because people can generate revenue from them and it doesn't have to just be a second home that they hold, right? And therefore the property values are probably higher than they would be if everyone was just an owner, right? That lived there.
Indirectly, a little bit, yeah. Not in the eyes of the bank, but in the eyes of the consumer, yes. If you can buy something that's going to make you money, you might pay a little more for it than if you couldn't rent it.
Mm-hmm. Avery, in St. Augustine, one of the things that drives our market here is I think we're top 5, believe it or not, in wedding destinations. So, I mean, like it is huge. You should look it up. I mean, there's so many people that come here and do weddings. I mean, all throughout the year, you can have a wedding here in January and that's a huge driver because you're talking about the number of people. So when you have 10 or 12 people in a wedding party, they don't want to go out. They don't want to rent a hotel. They'd rather go out and get a big house and spend $3,000 for the weekend or $4,000 for the weekend. Now, as you're looking at this market and you're investing in this, who should be looking into investing in your space and who should not be looking at investing in your space?
That's a great question. So I would say if you are not someone who is adaptable, then this space is not for you. It's also not, it's not like apartment buildings. So we have a bunch of apartment buildings. Actually, my husband did go through some of y'all's training back in the day before we bought those. And the income is what the income is until people move out and you update it and charge a higher rent. And it doesn't matter who owns it if that lease is in place. With short term, 2 people can own the exact same property and do wildly different income numbers just based on the way they manage it. So things like, do you have a 5-night minimum stay or a 3-night minimum stay, and holes in the calendar and things like that. So if you are not someone who is willing to kind of take control of your own destiny, and you just want to set it and forget it, like this asset class is not for you. It is a business. It can be a very lucrative business, but it's definitely not something that you can, okay, I'm going to throw it on Airbnb and not check on it for 2 days. You got to be in there every day, looking at your pricing, looking at, a lot of it can be automated. Like a lot of our guest messaging is automated now. Calendars are automated, cleaners are automated, but your pricing, you really have to pay attention to. And I think a lot of people bought in like 2021 that weren't treating it like the business that it actually is. Yeah, it's easy work. You can do it from the bar or the beach or the gym, wherever, but it is still work that you have to pay attention to managing. So if you're looking for like something completely passive, this is not short-term rentals. But I think that for new investors, short-term rentals are a great, I call it a gateway drug, because you're learning the real estate game. You're buying a single family. It's easier to finance than going and buying a multifamily to start off if you're buying by yourself.
You guys use community banks, or what do you find?
Oh, no. Any mortgage broker will do. Most of our clients actually at the short-term shop use conventional investment or vacation home loans because you only have to put 10% down. So you can get in. Yeah. So it's a nice little hack to be able to get in with a little less money.
There's such thing as a vacation home loan. Never heard of this.
Yeah. Okay. So vacation home loan is conventional. So you are limited by, what your debt to income ratio is, but you only have to put 10% down. So you're able to get in for less. There are a few stipulations, like you have to plan to use the property yourself for 14 days out of the year, or else it wouldn't be a vacation home, but you're allowed to monetize it the rest of the time. So that's a nice hack for people who are new to get in. And with vacation rentals, you're learning.
And that's a 30-year AM at like, whatever today's rate is. So That's pretty sweet.
Yeah, it's very sweet. So you learn how to invest in real estate. So if you decide to scale up later to other types like apartment buildings, you're kind of learning that. You're getting your feet wet. And you're also learning business and systems because you are running a hospitality business. Not only takes about like an hour a week, it's not like you're getting a full-time job, but you're learning systems and processes. And, maybe if you want to go be an entrepreneur in other ways after this, you can do that too. So it's kind of a nice entry point into both real estate investing and small business investing. So I think that especially for new investors, it can be a really great way to kind of get started and get some momentum going in your portfolio.
Would you be able to walk us through our framework of buy right, manage right, and finance right, of how you're looking at a deal? Because I think our framework is applicable. You've said so many things here about managing and financing and buying. When you're looking at a vacation rental, what are you looking at and how are you implementing that framework? Let's start with the buy right. What are you looking to buy? And also, Avery, I think exit strategy is an important component here as well. Are you holding these assets long term? Are you refinancing them? Are you selling them? Would you be able to walk us through that framework?
Absolutely. So buy right. The market is almost more important than the property itself. So you want to buy in a market where the friction of the regulations, that battle was fought a long time ago. Destin's a great example. Smoky's a great example. Places like that. And in terms of properties, so a lot of people make the mistake of saying, I want to buy as much property, like the biggest house that my budget will allow. But if you use some of the data sources like AirDNA, Price Labs, Rabu, you will find that a lot of times, especially if you're new and this feels like this really big thing that you're trying to do that you might seem too big, in vacation markets, studios and one bedrooms a lot of times make up less than 1% of the available rentals. So when you hear all these terms like saturation, that's more at the bedroom count level than the market level. So a lot of people like to say the Smokies is saturated. It has too many rentals. And that's an excuse for not managing well, which we'll get to the managing right in a minute. But when you look at the number of bedrooms, well, X amount of 3 bedrooms in that market, but less than 1% of 1 bedrooms. I own a studio and a 1 bedroom, and they both do between $60,000 and $70,000 a year because there's just not many of them. So you want to buy right.
So you can put a premium on that because people are looking for something maybe more affordable,
or smaller.
Or just when people come, there's just 2 people. The Smokies is the honeymoon capital of the South. So a lot of times it's just 2 people coming in. They don't need a big 3 bedroom. And they stay rented all the time.
Well, I think the point that I'm making is it's more affordable than renting a 1 or a 2, but you can probably get a little bit of a premium on like the per square foot on that unit. So that's pretty cool.
Yeah, absolutely. I love 1 bedrooms in vacation markets. Also, you want to make sure that your property is close enough to the attractions in that market. We saw a lot of people mess this up back in COVID when there were 1,000 offers on every single property of every asset class. They'd say, oh, well, I'll just buy a little bit further out and people will be okay with paying less to be further out. And when the tide went out on all that, the COVID travel, the people who bought too far out from the attractions in their markets are the ones that had to go first. So make sure you're buying in a market that has the good regulations, make sure you're buying the right property size, and make sure that I really like my favorite hack with buying right is properties on the market that have ugly listing photos. I mean, you guys know that a lot of times real estate agents, especially kind of the older school ones, they just take with their phone. I've gotten some really great deals on great properties that just had really ugly pictures. So other investors were swiping by because when it's, a beach house, it's not like an apartment building in Nebraska. They're like, oh, well, I want it to look better than that. And they just don't look at it. So buying right, you want to buy an ugly property in the best location at the right number of bedrooms.
What kind of cash on cash return do you expect on these things?
So for me, at this point, there's not going to be anything laying around on the MLS that is performing the way you want it to perform. So what I'm looking for is potential, not what it's doing right now. And I want it to get to I want to have the potential to get to above 15%. That's worth looking at for me. If I can get it to 20, like that's a home run, but I'm looking for the potential to get an over 15% cash on cash.
Okay, so we got the buy right. Let's jump into the finance right real quick, and then we'll go to manage right. So you talk about the vacation loans. Any other tips or anything else that you're doing to secure financing?
Sure. So vacation home loans are great if you have the room in your debt to income ratio to get approved. But then once you max those out, or maybe you're out of DTI, but you still have down payments, we use what's called a DSCR loan. Works very similarly to a commercial loan, but it's actually a portfolio product. And DSCR, for listeners who might not know what that is, stands for debt service coverage ratio. And for that type of loan to approve you, instead of basing your loan approval on how much money you make, they're basing it on how much money the property will make. So They want to see usually a 1-to-1 ratio. So if the mortgage is $5,000 a month, they want to see that the property will make at least $5,000 a month. And that one, as long as your credit is decent, then it doesn't depend on your debt to income ratio, just the property. So that's one that a lot of people use. Does have a much higher interest rate because the bank's gonna get their money somewhere. But those are the two main types of loans that people use.
And then finally, manage right.
Manage right. So this is a big one. Like I said earlier, two people can own the exact same property and either be successful or fail based on how they manage it. So short-term rentals are very subjective compared to other types of asset classes. And to manage right, at the very least, you need 3 pieces of software and you need to pay attention. But the software you need is a property management software. There's a lot of great ones that help automate everything. We use Hospitable. There's another one called HostAway, another one called Hostfully. There's a lot of really great options and they plug into all your accounts and bring everything into a nice dashboard for you. Automate a lot of your messaging, automates your cleaning. So if somebody books on one day, it will auto-populate your cleaner's Google Calendar so they know they need to go that day. So lots of great automation. You also, most important thing is you need a pricing tool. So I use Price Labs. There's also Wheelhouse and Beyond Pricing. And that tool is constantly analyzing all of the prices per night in the entire market, not just short-term rentals, but also hotels. And it works to make sure that it's pricing your property to get you the highest price per night. And where people make mistakes is they just say, oh, I got a pricing tool. I don't have to pay attention to that. You still have to know how far out you should be booking. So for example, in the Smokies, we typically see like a 5-week lead time. So we're in there looking at our calendars every single day. And if we see, our 5 weeks out, we should be booking better than we are right now. I think our pricing tools got us a little high. Let's knock that down a little bit to start getting booked. So the key to being a good manager is really just paying attention and trial and error. It's not some secret sauce like, here's my 12-step process, whatever. It's looking at your property every single day. So paying attention. And if something isn't working, fixing it, changing it, just change it until it does work. Because it's really, really not, people want to make it this big like algebra problem. It's really just a lot of common sense. If you're not booked, your price is too high. And it doesn't have to go lower forever, but for the nights that you're looking at that aren't booked, seems like it needs to come a little bit lower. So it's really just paying attention and managing your systems.
Before we go to the short answers, the word that we hear in multifamily is value add. It's like the golden word: material value add, functional value add. It's just so many different ways to talk about value add. For us, it's just going into an apartment complex, and the value add is either operational or it's renovation kind. Can you discuss a couple of types of value adds that you do in the short-term / vacation rental space?
Yes. And this is a really, really good question right now, because I think that this is something that short-term rental investors who don't have other types of real estate investments get wrong, because there are 2 types of quote value add you can do to short-term rentals. There's true value add, like you're increasing the value of the property. So kitchen renovations, things like that. And then there's income adds, so that don't actually increase the value of the property, which are things like adding amenities like putt-putt courses. We see a lot of pickleball courts doing full murals on the insides of properties. I don't know if you guys have seen some of these things in like Orlando, where they have full, like the houses are immersive themed Disney. So all of that is great, but people who don't come from the multifamily space, that don't understand the difference between what's actually adding value to the house and what will add income, but doesn't add value to the house. I've seen some people make some mistakes there. So for example, people coming in, buying a $500,000 house and doing $250,000 cash of amenities that don't add value to the house. And it's their first investment. They don't know if they're going to like short-term rentals. They might sell in 2 years, because 50% of all real estate investments are sold in the first 2 years. And they're not going to get that $250,000 back, because that house is not going to appreciate $250,000 over the next 10 years probably. And all that $250,000 they spent, yes, it'll make the short-term rental make more money in income, but it's not adding value to the house, and you can't get that back. So I see a lot of people making that mistake. And then when they decide to sell, if maybe it's not for them or they want to do something else, they can't get all their cash back out. So that's something that if anybody is interested in getting into short-term rentals, it's really big in the space right now to over amenitize, but make sure that you're either willing to change that property back or be willing to just lose that 250. So like we had it listed for a year, a property that had a fully immersive, like murals everywhere, 8-bedroom, $3 million, had amazing rental history. It was doing like $350,000 a year. And when we listed it, all of the feedback, listed it for sale, not for rent, all the feedback from the buyers who saw it said, at this price point in this market for $3 million, like we're looking for luxury. We don't want murals on the wall and like coconuts everywhere. And we want it to feel classy.
It was like too playful for them.
Yeah. So there is kind of a fine line with the adding amenities and adding value. And you need to make sure you understand the difference and the risks of adding a lot of amenities that don't actually add value to the house.
The pool situation seems interesting to me because I feel like there's going to be people that are looking for the pool, right? And they go on and it's like a great feature to sell. But that's the basic example that you just gave. Like pools have gotten really expensive. So if you put in like a great pool package, you could easily be upwards of $200,000 or something on that. So what is your thought there?
That's just
tough,
depends.
Right?
Yeah, it really is tough because like in Tennessee, for example, a $140,000 pool might only add $40,000 to resale value. But like here in Florida, it's different. You have to like your property is worth significantly less without a pool. So you have to understand your market.
And the marketing, like, there's people that are going on an Airbnb where they are vacation rental and they see the pool and they choose it because of that. So you're going to get more, higher rents and more, people interested in it. But it's like, damn, it's a big nut.
Jake, it goes back to the buy right where Avery is talking about understanding your market, knowing that in St. Augustine, Florida, it may cost $120,000 for a pool, but you may get another $50 to $100 per night. And it's also an amenity that is desirable. You're gonna attract a higher class of resident to be able to rent the property.
It's just pricey.
It is. But I mean, if you're going to be in the business and you're trying to compete down the street with somebody that does have a pool and you don't, they're going to the place with the pool down here in Florida, especially in like the spring and.
I'm the cheapo. I'd be like, I don't want to do it. I hate pools.
You ain't the cheapo. No, that's not you, brother. You're going, I'm going pool. I'm going big time, big league.
Yeah. And I will say, so two of our Florida rentals have pools. One of them does not, but it's like right on the beach. So we can kind of get away with not having it.
That's when you throw in the hot tub. Let's be honest.
Yeah. Well, so we thought about when we bought the one in Cape San Blas, it's like right on the beach. And we said, man, we're probably going to need a pool because over in Destin, you got to have a pool. And we said, let's see how it does the first year without the pool. And it's been 5 years now and we have not added a pool because it's done just fine without it. So it's kind of like a trial and error thing too. But I'll also say like in the Smokies, the indoor pool cabins are the real big thing right now. All of the new inventory that's been built in the past 5 years have that. None of my properties in the Smokies have pools. None of them are even really that luxury. They're nice. We keep them updated, but you have to also understand who comes to your market and why. The Smokies is
but your affordability factor, you probably have more at bats than the people with the indoor pools, though. So yes, I'm sure there's people that are going for those. But if you're marketing to more of a massive population, like I take that every day of the week.
Oh yeah,
I want more buyers that can potentially buy my stuff, right?
And that's the exact. You just led me into the perfect thing I was going to say is that the Smokies is a very blue collar vacation. It's not Aspen. So a lot of people came into the Smokies in the 2020 saying, we're going to develop these bumpkins out here. And there's no luxury properties in the Smokies. We're going to build all these things with indoor pools and make them, crazy luxury. But a lot of those properties, especially with the amount of inventory they added, they've pushed the price per night higher than what the demographic of the market can actually afford because it's not Aspen. And there may be people who go to Aspen who also go to the Smokies, but they're not going to pay Aspen prices for a Smokies vacation. So it's understanding who comes to your market too.
Cool. All right, let's take a quick time out to hear from our sponsor.
This episode of the Jake and Gino Podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information.
All right, we are back. Just want to talk about the market. I'm sure, 2020, 2022, that time period, you could put whatever price out there you wanted, and especially in the Smokies, it was getting leased up. How have things shifted, and what have been your learning lessons over the last 4 or 5 years?
So for me, I would say not. Think really the lessons have been more in the making sure you run numbers conservatively. My properties were fine all through COVID. We did totally
fine. I mean, you were probably excelling, no?
Yeah. We did the
it
highest
wasn't that you were
price.
fine. That was probably your best time ever, right?
Yes. So 20 to 22 was the best time ever. And a lot of people call it like the Airbnb bust of 2022.
Oh, I haven't heard that. That's a new one.
Oh, you haven't heard that? Well, I'll tell you about it. So a lot of people that bought in 2020 to 2021 saw a decrease in income between those years and 2023, which we all did. And so they're like, oh, the Airbnb bust, Airbnb's going down. But actually, if you kind of like move that x-axis or whatever the vertical axis is.
If you didn't buy during that time and overpay and you were in at 2019 prices, you're probably killing it still, right?
Well, yeah. And what I would want to point out is the income now, even though it was higher in 2023, is still almost double what we were happy to get in 2015. So it wasn't really a bust if you just kind of zoom out and say,
but that's what I just said, though. It's people overpaying at the height of the market, right? And then they're carrying higher mortgages.
Well, that too, but there are a lot of people who had great income who didn't necessarily overpay, but saw that their income went down, still totally able to cover everything, still cash flowing, but not as much as they were, who were like, oh, it's the end, I have to sell, even though they're not in any financial trouble with their properties. But the income for short-term rentals overall is still very much on an upward trend. We did have a little blip, but it wasn't, if you zoom out, it was a blip and not a bust because, properties we had in 2015 that were doing $45,000, they did $85,000 in 2022, but they're still doing $75,000 now.
No, but that's my point. Like, the people that bought before the height, right, they hit a extreme high, which was great for them. But even if they came down 10, I'm sure they got in at a lot lower basis. That's what I'm saying. So the people that were buying pre-2020 that just held are killing it, right? It's the people that came in at a high, their income got reduced a little bit. They're kind of like holding their nose at things.
Freaked them out. Yeah, for sure. Freaked them out. Yes. And, it's just like anything, any asset class. It's real estate is get rich slow. You can't expect to quit your job on owning one property for 6 months or two properties for 2 years. It's a slow, gradual.
The thing that people don't get, if you bought in 2015 and then you look back in 2025, you go, shit, my world has changed a lot. But it's hard to look at things in 10-year windows. That's why we always say think in decades. Easier said than done. Most people can't do that. They're in for 2 years. Meanwhile, if they stay in from 22 to 2032 and they look back, they go, oh shit, if I manage this well, life's pretty damn good. But it's hard to have that vision.
Yeah. It is. And I think that that's with just real estate investing in general. People think, oh, I'm really into this. Like they'll get really into investing in stocks for a little while and they get really into real estate investing. They own something for a few years and then they're like, I don't feel like dealing with this anymore. Whereas if they would have just held it, they would have built some wealth and just kept going and kept reinvesting and kept buying more properties. Eventually you turn around and go, holy crap, we have a big portfolio and it's doing really well.
Avery, can I ask you a question real quick on boutique hotels? What are your thoughts on boutique hotels? It seems as if that's the new fad, whereas short-term rentals and vacation rentals.
How many units are these, Gino?
2005. I don't know. I just see a lot of people popping up and going with these like little boutique, and it's like what Avery said. It's a business. It's not like a little, happiness place where you have. I don't know. They make it seem so sexy.
It's my yoga studio because I love doing yoga and I like fancy purple things. things.
You need to buy it right, manage it right, and finance it right. And a lot of the software that Avery talked about, it seems as if it's just a larger scalability than having one or two little vacation rentals. What are your thoughts on the boutique space right now? Because it is the rage. Everyone on Bigger Pockets is talking about it. All these new influencers are talking about it. I want to know
because it's Instagram sexy, and that's why it works.
Oh, dude, they look so awesome. I'd love to own one if I didn't have to work at it, just to say I own
No,
one.
you don't want that shit.
Yeah. I mean, I'd love to own like a cool Route 66 motel. It is the cool thing right now. And there's some pluses and some minuses. Minuses for a brand new investor who's never gotten a commercial loan before might be a little bit tough. Pluses, if you've got a little experience, like maybe you own a short-term rental, it's now a commercial property. So if you can make more money, then you make it worth more. Whereas with short-term rentals, even though it indirectly affects the value, the bank looks at them as residential. So your house that makes $100,000 in the eyes of the bank is worth the same amount as the house next door that is not a rental at all. So you do kind of open up some ability to increase value of the properties when you're doing a boutique hotel. And they're really fun and cool looking. I
don't want the upkeep on the cool, right? Like I don't want the shag rug that after 3 tenants come in, they ruin that shit and I got to spend 10 G's to replace it. And there's a little piece of paint missing from my pickleball court and it pays 10 G's a night.
Glass half empty, my friend. You're usually the glass
No, it's not the glass half empty. It's a pain in the ass. You deal with that shit. Dude, Gino's so full of shit right now.
I'm not disagreeing with you, but I'm saying
you're drugs before this show. Okay, Gino did drugs before this show. It's confirmed. I'm not buying anything he's selling today.
No. Well, I will say, like I am with Jake on it. It looks really cool on Instagram. People want to watch you learn how to do it and build it up, but it's probably not something I'm going to do. Maybe I'm tired these days. Don't want to learn.
No, but you realize how much work goes into it. And you got to keep it up to a certain point where, your place that you mentioned on the beach that doesn't have the pool, that's absolutely killing it. You can create an amazing, clean, presentable unit that's easier to manage and does well for you. And someone's not bitching because the shag fur is an inch shorter and smells like cat pee now or something, right? Like
right.
This stuff is real, and you got to understand like how much crap you want to swallow when it comes to that. So
yeah.
Gino's turning red because he knows he's full of shit right now. Look,
I guess no boutique hotel, Jake. I was thinking hopefully we could, buy
Gino,
one.
Let's go stay at one. Okay, let's go stay at one that's got purple shag and like a Corvette from the 1950s hanging off the wall when you come in. That's fine. Okay, we'll stay there and we'll take the money from the place without the pool. I'm getting the feeling that you self-manage, but we haven't sort of dove into that. Is that something that you do, or you want to dive into that?
So 8 of our doors are vacation rentals. So not a huge percentage of our portfolio door count wise. We manage those ourselves. We do have some VAs that it's part of their job. So they work with us across all of our businesses. And as part of their jobs, they help with the short-term rentals, but it's not a full-time job for them. But to give you guys some perspective.
Okay, I'm totally confused now. You got to break it down in very simple terms. So you got 250 doors. 8 of them are self-managed?
8 of them are short-term rentals. The rest are like apartment buildings.
What is that? Oh, so the rest of your portfolio is apartments.
Apartments and single-family long-terms, yeah.
Okay, so there's 8 that are short-term rentals in the portfolio, and you self-manage those.
Mm-hmm. Yes.
Ah, okay.
Yeah.
Peeling back the onion.
Huh?
So we're peeling back the onion now.
Yeah. So the reason we self-manage them is because the average property management split nowadays is no longer 40, but it's more like 20, 25. And if we paid somebody 20% of what we make on those 8, we'd be paying somebody like $250,000 a year. So for what is maybe like a $45,000 a year office job, it does not require a lot of skilled work. So we have our VAs who help with, everything, not like the short-term shop, our education program, all of our different property asset classes. Part of their job is to help with the short term. So we teach our clients how to use VAs, how they have to sell. We teach them to do it themselves alone for 6 months to really learn the processes so they can train a VA. Then you can get a VA to help you for much, much cheaper than paying somebody $250,000. I can go buy another $1 million apartment building with that. So,
yeah. So, and then the apartment side of things, do you self-manage those or those?
Apartments we've got with managers.
Gotcha.
And I think a lot of people think that self-managing long terms would be easier than self-managing short terms, but it's kind of like the opposite. Because with long terms, you've got to do, we're doing background checks and credit checks and employment checks.
The cleaning is the big thing with the short-term rentals. You got to have probably A+ cleaners, right? That's the big thing.
Yeah, 100%. Your cleaners have to be great, and you treat your cleaners like absolute gold because they'll
make
are
or
the
break
thing
you.
that will make or break your business.
Yeah, I could see that. Any tips, for you guys scaling it out? Because you said you started off as like 40% to get into it or whatever. So did you start right out with self-managing, and then you kind of just built it out? Any tips in how you scaled that? It sounds like the VAs were a big part of it.
So we didn't have the VAs until about 2020. So for the first 5 years, it was just myself and my husband, Luke. And
managing the cleaners.
Yeah, managing the cleaners. And really, the way we've scaled and still to this day, we don't live off of $1 that we make on our rental income. We are only using that to buy more properties, which bought less properties the past couple of years because the market has sucked and deals have been scarce. But
market sucked in what way? Like you're not cash flowing as well, or there's just no deals out there?
There's no deals out there.
Okay.
Hard to find deals. So we bought a few things here and there, but there's just not as many deals out there. It's harder to find. So I think that the biggest mistake that I see people make with scaling is seeing, they get a couple properties and they're like, oh my God, I netted like, I don't know, $50,000. I can quit my job. And then they quit their job. They cut off their income to be able to buy more. And they're living off of their short-term rental income. So they don't have that money to reinvest. So they kind of like cut off two of the legs.
They exit too early. Yeah.
Yeah. Yeah.
Interesting. All right, Gino, you ready? Did the drugs wear off yet?
I'm just about to say, there's a disclaimer. No drugs were ingested prior to the recording of this podcast. I just love being on the Jake and Gino show with Jake. That's why I'm eternally happy on this show. But anyway, Jake, it's interesting. Avery Carl got a soccer scholarship, University of Tennessee. And from there, she started bouncing. Texas. Oh, Texas.
No, there's only one UT. She said UT. That's why it makes no sense.
That's why I said Tennessee, Nashville. So she's bouncing around.
Like we want to join the SEC, me too, kind of stuff. All right. Sorry.
She ends up in New York, meets her husband. They decide to move down to Nashville because New York is just crazy. She gets a pay raise, starts buying some real estate in Nashville. And she probably says what most beginning investors say is this too good to be true? I can buy a house here. The resident can pay down my mortgage and I can make as much money on a couple of deals as if I went to work doing it. I think the light bulb went off.
Paid a little better than the punk rock.
Yeah, yes. And there's no one going to take her job. There's no one's going to ask to make less money than she's making. She's controlling her own destiny. They end up moving on to Florida, the land of the free.
Yep.
Love Florida. Ends up opening up shop down here and starts buying the short-term rentals, buying the vacation rentals, and exploring multifamily. And what I love about it, it's the framework. If you learn how to buy right, you learn how to manage right, or you learn how to finance right, Avery's written a book. It's right behind her. Smarter Short-Term Rentals. Go check it out. I mean, Avery, where can the listeners get a hold of you, get your information, buy your book? Where can they learn more?
All right. So you can buy my book on Amazon. You can walk in Barnes & Noble and get it. But probably the best deal is going to be on the Bigger Pockets bookstore. So it's biggerpockets.com/smarterstr. It is on Audible, etc. if you need that. If you want to be a short-term shop client, we are the top short-term rental specific real estate team in the country. We've been number one at the biggest brokerage in the world 3 years in a row. And we teach all of our clients how to manage the same way we manage for free if you use our agents. So you can find us at theshorttermshop.com, at the Short Term Shop on Instagram, or if you want to follow my day-to-day of what I do as a full-time real estate investor and running the Short Term Shop, you can follow me at the Avery Carl.
Right.
I'm not sold yet, Gino, but I like it. All right. I like it. So
when you booking a hotel for us, brother, when are we going? Huh?
Yeah, I'm all about using them. I'm just not about owning them for sure yet, but I like it. So
yeah. Well, just get one in a place you like to go.
That's the problem. I'm a weirdo. Like I don't want anyone else sleeping in my bed. That's why I can't get there. That's my biggest thing. Like
he's a weirdo in more ways than that. That's not the only way he's a weirdo. His weirdo list that's
the biggest problem. If I can get over that, hey, maybe it's in my future. So we'll see. But gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the G Daddy. We make it happen. We'll see you next time.
Thanks, Avery.
Thank you.